Welcome back everybody to Rod Pierce's Property Investment Education video series. Today we'll talk about chapter 4.1, setting your property investment criteria. It's absolutely crucial that before you embark on your property acquisition journey, it's essential to define your investment criteria. How can you find the right property if you don't know what you want out of that property? Setting clear investment criteria will help streamline your property search and focus your efforts on opportunities that align with your investment goals and risk. Consider factors such as defining your investment objectives. How much income do you want? Focus on properties that offer high rental yields, if that's what you're chasing, stable income and highest income possible. Chase properties of high capital growth. Look for properties in the area with the strongest growth potential if you are chasing a high capital growth strategy. Or even a mixed strategy, seeking the property that has the balance between rental income and property appreciation, noting that property appreciation alone makes you faster money over the longer term based on capital appreciation. But you may be chasing stable income. It all depends on your criteria, but you've got to set those objectives. Establish your financial parameters, setting a maximum budget based on your loan affordability, your borrowing capacity, and your risk tolerance. Understanding how much cash is required for your deposit. Determine the amount of deposit that you can afford, typically 20% plus costs for your investment criteria to avoid mortgage insurance. You can always leverage it higher depending on your criteria, if that suits you. Financing. Choose the right financing structure and the maximum interest rate that you'll be willing to accept. The loan structure is critical and the cost of funds is critical for the right outcome. It all depends on your criteria. Identifying target locations. Looking for locations that provide for employment stability, economic stability, areas with growing job markets and a diverse economy. Looking for areas of population growth. Set your criteria on what you're looking for. Victorian metro regions, capital states, Queensland, international, wherever it may be. Are those regions experiencing population growth higher than the demand for property? Looking at infrastructure and amenities, proximity to schools, public transportation, healthcare, shopping centres, etc., as we've spoke previously. Look for areas and understand crime rates. Low crime rates tend to ensure more tenant safety, in theory, and property valuation retention, in theory. It all depends on your criteria. Determine the property type and the features that you want. Is it a single family home? Is it a townhouse? Is it a unit? Is it an apartment? Is it a commercial property? Understanding what the types of properties that you want to invest on is important before you start to look for something. Age and condition. Is it, set the criteria. Do you want a new property, an old property? Decide if you prefer newer properties, or willing to invest in older properties that may require renovations. Do you have the cash for those renovations? Setting the criteria becomes important. Size and layout. Is it a small studio apartment or a 4-bedroom house or a 5-bedroom house? Consider the number of the bedrooms, the bathrooms, the rental opportunity, and the overall square meterage of that particular site. Some lenders will dictate that they're not interested in smaller properties. Have a look at the amenities or consider the amenities of the property. Parking, storage, laundry, living, outdoor areas. Crucially, you must set financial performance metrics. What do you actually want? What is an expected rental yield that you want out of that property? And rental yield is simply a calculation of dividing the amount of rent, gross rent, divided by the property price. Looking at cash on cash returns, as we spoke earlier in previous sections. Annual pre-tax cash flow, simply divided by the cash invested. They're all criteria that we need to create. Understanding occupancy rates. Is one area better than the other with regard to occupancy rates? Is vacancy, in one particular area more, volatile than others? They're all considerations with setting the criteria. Risk management criteria is another aspect that we need to consider. Market risk, evaluating the potential for market fluctuations and economic downturns. How much can we tolerate with regard to fluctuations? And we establish that by setting our criteria. Tenant risk, property risk, consider the potential for unexpected repairs, maintenance and costs and so forth. Whilst they can be insured, we don't want to go through that process. So set some criteria there. Regulatory risks, zoning laws, are they potential changes to zones that are going through? Are there freeways going through? Are there changes to rental regulations? Homeowners associations, right? and tenants' laws are changing. And importantly, make sure that within your criteria that you set an exit strategy, understanding a time horizon. How long do you wish to hold this investment property for? Have an exit plan. If something was to go wrong, if the criteria was not to be met, how do we get out of this so that we can then redirect our important cash flows, time, efforts to the property that's going to give us the return that we want? Understand market liquidity and choosing properties in an area with high market liquidity to facilitate easier sales or quicker sales. They're all important considerations to set the criteria. Happy investing. See you on the next chapter. Bye for now.